All right, let's check in on the fixed income and currency markets. And to take us through that, we've got Ashish Vaidya, who's head of fixed income, currencies and commodities trading at UBS, joining us now on the show. Ashish, to begin with, we've got the current account deficit numbers for FY12, which is expected to be released today. Would the markets be looking for any signals from that number in terms of what we should expect for the current financial year?
I think, the number which is going to be coming out is obviously the old number when probably the oil was still high and, rupee was undergoing correction. So I don't think that this should be the number which should be really watched in a very meaningful detail. I think it's important to watch what will be the number coming post that. Because, and you could decipher that from the trends which you're seeing in oil markets and also the gold imports and everything else. And hence, probably going forward, the quarter after that, the current account should certainly be much lower.
Right, and the belief is that the current account will possibly come in at about 2.7, 2.8 in the current financial year. And focusing on the rupee, would you say that, the 57 odd levels that we saw last week could have been the bottom for the rupee, and that from here on, possibly you will continue to see the rupee appreciate? Is that a fair assumption to make?
I don't think it's really possible to hazard a guess about this in the overall global context, So if everything goes well in the euro region and some sort of a risk appetite returns, then I would say fine. 57.5 would have been topish. But, I think broadly we should look at a range between 55 to 58.5 on a very macro basis for the next, say, 3 to 6 months.
Ashish, how dependent would you say the movement of the bond yields is on U.S. Treasuries, crude oil prices, and the global equity markets vis-a-vis OMO operations?
I think it's obviously much more, in tune with the OMO operations. In fact, despite whatever we are thinking in terms of, yields softening because of rates cuts expectation, and which is setting in basically because the demand is sort of slowing and GDP, IIP, everything is sort of falling. But the fact is that yields are probably here because the RBI OMO is still on. And let's watch that out, because if the currency stops to depreciate, and typically this season, which is July, August, the currency in circulation actually increases. So, if that be the case, then I think it will be hard to find OMOs going ahead in the government bond market. And I would construe that if that be the case, then I don't think there will be any case for yields to really come off. In fact, despite the fact that oil is lower, despite the fact that fiscal, from the oil perspective, will start looking a little better, and inflation will eventually come off, but at the same time, the supply pressure will keep it up. So I would expect from these current levels, maybe, you still see about a 15 to 20 basis point uptick in government bond yields, especially the 10-year benchmark.
Right now, Ashish, I think after the mid-quarter review, when the whole market was expecting the RBI to do something by way of a repo rate cut, and it didn't happen, expectations for anything to happen in July also have pretty much gone away. Would you still be of the view, as most of the market is, that we will possibly see a quarter point cut in October at least?
I certainly feel that we are somewhere in a downward trajectory. Now, I think October, would be a fair assumption. But given the statements that have come out of RBI, and specifically giving, weightage to the inflation, I don't think we should look at, any cut in July.
Right. So must we even assume for a sort of provision for a scenario where we may not see any more rate cuts in the whole financial year? Is that a possibility that you're factoring in as well?
Well, that is very doubtful, right? And in fact, the market is also not factoring in that. The reason you are having the 10-year yields at this level in the government bond market, and in fact, if you look closely at the swap market, they're still pricing in a good amount of cuts. So I think the swap markets in India are typically right now pricing in at least 75 to 100 basis point cut over the next 1 year.
And what levels?
I think it's fair assumption to sort of expect a cut, and probably going ahead, somewhere in October types.
Ashish, what levels do you see on the bond yields in the absence of regular OMOs by the central bank and the heavy supply of debt which is slated for every week till nearly September?
Now, it depends on what term are we talking about. So if you're talking about, say, a month from now, basically a range from here for a month, then I think I would say anywhere between 820 to 840 levels. But obviously, everything is subject to the fact that what happens overall in the macroeconomic environment in the world. So, if you have a situation of risk-on environment actually building on, and if you see the European situation getting, resolved to some extent at least, then I think you could see the yields maybe even a little bit more higher. But it will not go substantially higher from 8.5 levels simply because there are rate cut expectations, which the market will keep it in mind going ahead because growth has slowed down. So that's something which is bound to happen.